Let's dive deeper into the rates complex now with Jim Bianco, Bianco Research. Jim, great to have you with us. Great to get your take. Where do you think 10-year yields go in all of this? I mean, I don't know if when we started 2022, if I asked you where 10-year yields would end the year, I don't know if you'd come up with this number, given what the Fed was going to do. But where do you think they go in 2023?
Well, I think the big issue with the long end of the yield curve is going to be the short end of the yield curve. Now, 10-year yields, as you pointed out, are around 350, and they're about 80 basis points below, or 0.8% below, the 2-year yield. If the Fed is true to their word, and they're going to raise rates to 5%, and they're going to hold rates at 5% for most of next year, you can expect that the 2-year yield will probably go above 5%. It usually trades higher than what we call the terminal rate, or where the Fed stops. With the yield curve being so inverted at this point, it's almost like the short end is going to force yields higher. So where's the 2-year note, or where's the 10-year note go? I think it's going to be forced higher by higher short rates. The Fed's going to get what they want. They want higher rates. They want tighter financial conditions. And the short end of the yield curve can kind of drag the long end higher. Not a whole lot higher. I mean, it's not going to go to 5% or something like that. But, you know, it can make another run at 4 and probably go above 4%.
Hey, Jim, so if you know, I know, and the rest of the world knows that the Fed usually is slow to act and long to stay whatever they did, and there's a lag effect, how come they haven't learned their lesson, and why will they stay too long?
Well, they have gotten, to answer your question, how have they learned a lesson? They're actually relying on some new research that says that the lag effect is much shorter than they think, that the markets price it in immediately because of forward guidance, and this is kind of technical talk, but they think the lag effect is a lot shorter. The second thing is their focus right now is inflation. So while a lot of your discussion earlier on was about whether or not we're going to have a recession, which is real growth, whether or not that's going to impact earnings, which is real growth, they're focused on prices. And Jay Powell couldn't be more clear. He wants prices to go down. And if it takes a recession to get prices down, it takes a recession to get prices down. He won't say it, but that's where their focus is right now.
So, Jim, is there a limit to inversion, to how much that spread between the 2s and 10s? Because I'm just wondering if the 10-year could actually still go down, and that in and of itself, you know, the deeper inversion and the 10-year moving the way you're saying it should move, but the opposite of that, if that will really be the forecast for a recession.
Yeah, well, first of all, the inversion is at a 41-year extreme. You got to go back to 1981 to find it the last time it was this extreme. No, there is no limit. There's no mechanical rule that says it can't keep inverting. But if you also think about other developed rates, and I'm thinking about Europe, short rates in Europe, because of the ECB's hawkishness today, made a new high for the year. That tends to impact our market too. So if they're trending higher, that's another pull on our market, and that's happening all across their yield curve as well. So no, yeah, we could go 100, minus 150 or minus 200. There's no reason to do that. But when you're at a 40-year extreme, and it is already screaming recession because it is so extreme right now, I think if the next move in short rates is higher, it kind of drags the long end screaming and kicking higher as well, too.
All right. Jim, thanks. Jim Bianco, Bianco Research. Guy, what do you think? 10-year gets dragged higher?
I respectfully disagree. Jim's forgotten more about this stuff than I know, but I will say that one of the things I've been positing for a while is this thing's going to go to 1% inversion, and I thought it would get there in the form of 3.5% in the 10-year and 3.5% in the 10-year and 4.5% in the 2-year, and we're getting pretty close. So I still think that's where we're headed. 10 years is going to stay anchored because growth is so slow, and 2 years going higher because inflation's out of control. And I think that's going to continue for the foreseeable future.